The start of this year has been pretty rough for basically anyone who's invested in growth and tech stocks over the past 2 years, myself included here, with most of these companies getting hit very hard in the financial markets. Now, as investors, this is definitely something we have been speaking about quite a bit over the past several months and also somewhat predicting, considering the fact that the Federal Reserve has been speaking about raising interest rates in the beginning of this year and moving into all the way into 2024. So usually increased interest rates has a negative impact on growth stocks, as these are companies that require a lot of debt capital in order to fuel their growth. But what's even harder is continuing to maintain a longer term investor mindset when we're faced with stocks being absolutely crushed, right? Some of these growth positions are down 40, 50, maybe even 60% from their all-time highs. And maintaining that long-term outlook based on a thesis that is sound for a given company is definitely something that's really hard to do in a moment like right now, where you start putting into question your initial thesis and thoughts on the company's long-term growth and prospects for your portfolio. Now, I've always been an advocate for properly diversifying your portfolio and having a solid foundation of low-cost index funds to your portfolio for riding out market cycles over the long term, instead of being, say, fully exposed to a handful of individual stocks. And so time and time again, this is why I bring up the importance of holding ETFs like an S&P 500 or a total US stock market ETF that have hundreds of positions in one single holding at a very low management cost to you. For any other tech stocks right now, though, determining whether or not buying more, averaging down, holding, or selling is pretty much the million-dollar question, right? So that's why in today's video, we're going to be looking over 4 different tech stocks that I personally hold in my portfolio that have been either absolutely demolished over the past couple of months or down a little bit, but we're going to be speaking about where these companies stand right now and my thoughts on whether or not they're a buy, hold, or a sell. Oh, and before we jump into stock number 1 here, my name's Griffin, and this channel is all about helping you better your finances. And I'd also like to take a second here to thank Moomoo for sponsoring today's video, but more on that later. All right, so the first tech stock we'll be speaking about, of course, we have to mention Facebook, or well, now it's considered to be Meta Platforms, but it's still trading under the ticker symbol FB for now. So if you have followed my channel over the past couple of years, you would probably know that I have been a long-term Facebook bull. Over the past week, though, the stock has been absolutely demolished after their earnings report, being just shy of analyst estimates on most accounts. And this, of course, has sent their stock tumbling down tremendously, now down over 30% from the pre-earnings level. Yeah, in fact, it's pretty crazy to think that this one single earnings report wiped out over $240 billion worth of equity from the company's value, which actually also ended up being the largest one-day loss by a US company in history, which is pretty impressive. There's no really other way of putting it. And this has undoubtedly also had ripple effects over into the rest of the American tech space. For the time being, though, Facebook still remains one of the most powerful and influential digital advertisers in the entire world. And when we're looking at a stock like this that's been absolutely thrashed over the past couple of weeks, well, unless you're looking at this at a short-term swing trade position or a day trading standpoint, well, this is a stock that if you're looking for a long-term hold in the first place anyways, we need to ask ourselves as investors, is this the type of company that warrants this type of negative price action down 30% in such a short time frame, considering the fact that this is still a company that is so dominant in a growing industry? And is this company going to be in a better position in 5, 10, 15 years from today? Let's also consider that this isn't the first time we've seen Facebook shares sell off so dramatically in a short time frame. Back in 2018, Facebook shares dropped by 19% when it was experiencing a slowdown in user growth at the time also. But again, we need to ask ourselves as investors, just because Facebook's seeing some really negative price action for the time being, this doesn't necessarily change the growth of the digital advertising industry over the next couple of decades, as well as Facebook's position in it as of right now. We tend to look at a lot of short-term news when trying to value stocks and determining whether or not we want to get in on a stock right now. But again, maintaining that longer-term view is going to be important in my view when it comes to a company like Facebook. And right now, where do companies spend money when they're looking for digital advertising? Well, in 2021, US digital advertising spend soared past $211 billion, which represented growth of 38.3% over 2020, which is absolutely massive, and Facebook's accounted for 23.8% of that amount. And even further, according to eMarketer, the US digital ad spend market is expected to surpass $300 billion by 2025. So there's no slowing down for digital ad spend. That's a given, and Facebook is undoubtedly going to continue riding that growth of this industry. All right, now regarding why Facebook took such a nosedive, let's take a look at some of the recently reported financials. So first and foremost, Facebook's monthly active users users remained flat from the third quarter of 2021 over to the fourth quarter at 2.9 billion. And usually flat user growth is something that companies like this are trying to avoid. You're trying to onboard more and more users to be able to generate more ad revenue. Now, taking a look at Facebook's price to earnings ratio right now, though, considering such a dramatic drop in share price, we can see that Meta's PE is among the lowest that it has been basically ever, really, at below a PE of 17 as it stands right now, which is pretty incredible to think and could absolutely be a bargain price right now if you are looking to hold it for several years down the line. All in all, the way I see this though is that the fact that a company of this size and magnitude can drop down by 25% in market value in one single trading day from their earnings being missed slightly is really a testament to the market environment right now, as well as the level of volatility and really just overall fear and uncertainty that investors are applying to their positions. All right, moving into the second tech stock that I've had a lot of viewers ask me to comment about over the past couple of weeks, we have Lightspeed, ticker symbol LSPD, both on the TSX as well as in the American markets. Now, this is a stock that, let's remember, we first spoke about back in early 2020 when it was trading at around $30 per share. That's initially when it was on my radar. I bought into that stock now almost 2 years ago and saw it ride significantly over around a year and a half period, all the way up to around $150 per share in the Canadian markets. Now, again, in a recent video that I posted, I had mentioned the fact that I had personally offloaded a substantial amount of my shares at around the $130 per share range to materialize some of those absolutely insane profits. Now, as I mentioned in that video, this was somewhat luck around the timing of selling off some of those shares, as in no way could anyone or any investor have expected that this company would be in legal crossfires, where right after there was a short sellers report and the stock went tumbling down quite significantly and has since never recovered. It's just continued selling off now to a point where we're seeing price points that were right at around the March 2020 level. Since that video though, where I'd spoken about selling off a portion of my shares at around the $130 per share range in the Canadian markets, I have not sold off anymore. I've held on because I did not want to make, or I didn't want to sell off any shares before making a video speaking about that to the audience. So here we are now at a point where shares are trading at just above $30 a share, which is pretty staggering though, as it shed off the entirety of the gains that it's made since last July, down over 75% from all-time highs. So, above the fact that a company like this that is not profitable and that is relying a lot on acquisitions as well as debt to fuel their growth, of course this was not going to be a good position for this company moving into a higher interest rate environment. And combine that with the legal issues going on right now, this is pretty much a recipe for a stock seeing a lot of red days. Lightspeed's also seen some changes recently in upper management. So the initial CEO Dax De Silva recently stepped down, and the new CEO JP Chevet has now stepped in to take his place. Not a day into his new position though, and JP mentioned that the company is on track for organic growth of 35 to around 40% a year are his estimates, but the real kicker is that he's mentioned a less dramatic focus on profitability in the short term. What we need to consider as investors right now though is that the market overall sentiment and environment, I guess we could say, is completely different right now than it was a year back, where overall market sentiment was extremely bullish, and that's why we're seeing many companies being valued at huge multiples of future expected growth. Right now though, that's not the current market environment that we're living in. And so for Lightspeed to come out and say that they're not necessarily focusing on profitability in the shorter term, I don't necessarily think that's going to be a good thing for shareholder returns over the next year. That being said, the new CEO has mentioned the fact that moving forward, they are going to be focusing a lot more on the growth of their POS system over, say, the growth of their payments gateway, which I do personally think is the right course of action, as this is really where they are going to be able to differentiate from other behemoths like Shopify that have also entered the POS space. Still though, this company is burning through massive amounts of money. So Lightspeed reported after the close of markets on Wednesday a net loss of 65.5 million USD, representing 44 cents per share, compared to a net loss of 42.7 million USD or 39 cents per share just 1 year prior. So of course, being unprofitable, we can look at, say, the price to sales ratio for Lightspeed, which is way down to roughly the 8% range, which is among the lowest that we've seen for Lightspeed since the crash in March 2020. But still, I don't necessarily think that this is a company that's going to be seeing a tremendous amount of growth in the next year or so, considering all of the market headwinds that are going to impact it, but then also its own personal headwinds. So as it stands right now, with the shares that I have left over from my Lightspeed position, I'm just going to be holding on to them and really really everything we're seeing for this company right now is pretty much in line with what I was anticipating, and I do think we're going to continue seeing a lot of volatility for this stock over the coming year. Hey, by the way, if you're interested in any of the stocks that we're speaking about in today's video, or buying basically any other stock for that matter, that's made extremely easy with today's video partner, Moomoo. What makes Moomoo different is that this is a trading app that has a ton of built-in features and functionality right into their app, like free level 2 US market data and commission-free trading for US residents, real-time market quotes for all of your favorite stocks and cryptos, in-depth company financial data that's displayed in easy-to-consume visual graphs, short-selling data that's updated daily, access to IPOs and extended trading hours, and a ton more at no additional cost to you. And for a limited time, if you're a new user to Moomoo, you'll get the chance to receive 2 free stocks valued up to $3,500 each when you simply open an account and deposit as little as $1 using my link down in the description. So in total, you can get up to $7,000 worth of free stocks when you deposit only $1 into your account. What's more is that if you do make a minimum deposit of $2,000 into your trading account, you'll get an additional 3 free stocks, also each valued up to $3,500 a piece. So that's $17,500 in potential stocks that you get when you open and fund a Moomoo account. So make sure to use my referral link down below in the description if you're an American resident to open up your Moomoo account and claim your free stocks. And by the way, if you're Canadian, Moomoo told me they are looking to enter Canada over the coming months, so stay tuned for that. All right, moving back into the video here, the next tech stock we're going to be taking a look at is Amazon, ticker AMZN. Now, this is a tech stock that has not been beat down as much as the others over the past 2 weeks, but does remain down around 15% from its all-time highs, and that's after over a 10% increase in the past 2 weeks, driven by strong quarterly earnings. Now again, if you've been following my channel for the past couple of years, then you probably know that I've been a long-term Amazon bull and continue to be bullish on the future growth and expansion of the company, but then also their share price over the next 10 to 20, 30 years even, as this is a company that I periodically use their products and services. I love them, and I really think that their expansion into multiple different product or business verticals, I should say, is going to help them further expand and reach new markets. Yeah, so Amazon is always a stock that I'm happy to buy into periodically on the dips, considering a long-term investment horizon for this company. And again, you need to ask yourself with any of the companies that we're looking at in today's video, or any other company that you're looking to potentially invest in, is this a company that I believe is going to be thriving in 5, 10, 15 years down the line? And if yes, well then short-term price variations and fluctuations like we're seeing currently with Amazon really over the past year should not really be of that much importance if you're maintaining that long-term view with that company. In their most recently reported quarter though, Amazon posted some absolutely fantastic financial results, mainly driven by growth in both their AWS cloud unit and its growing advertising business, right? We're seeing some correlations here with growth in digital advertising. Amazon sales for the quarter were $137 billion, which happens to be up 9% and is also on the higher end of the company's own forecasted range. What's also driven investor optimism towards Amazon is their increased profitability this quarter at $14.3 billion in profits, which doubles the net income from last year. Now, in regards to Amazon's core business, we're looking at online store sales of $66 billion, which is down 1% actually from 1 year prior. Now, this could be seen as a bad thing and stagnant growth. However, I don't necessarily think this is the case. If we think about it, 1 year ago, we were pretty much in the height of the pandemic and also people purchasing stuff from home. So the fact that 1 year later, with most stores in the US at least that are back up and open, brick and mortar I'm speaking about here, well, this to me shows that we're continuing to see growth trends towards e-commerce as a whole. What has grown the most though for Amazon is again their AWS unit, with revenues of $17.8 billion in the quarter, which is up 40% over last year's quarter, which is great to see as cloud infrastructure is a continuously growing industry. And in fact, this is also the case with Google and Microsoft that also have very large and growing cloud divisions to their business. I also mentioned earlier that Amazon had a fantastic quarter in regards to their digital advertising. So their revenues for this section were at $9.7 billion, which is also up 32%. And let's consider that these have much larger margins than their core business in the first place. So what this really tells me as an investor is that with Amazon's continued focus on expanding their business verticals, this has absolutely paid off, where even though their core business is somewhat flat year over year when comparing it to 2020, well, these other business verticals that are growing at a much quicker pace are able to continue maintaining Amazon's growth momentum. And finally, when taking a look at Amazon's price to earnings ratio, this is something I've mentioned in multiple previous videos where it's by far the lowest that it's been in around the past 10 years. So all in all, Amazon's a company that I have no issue continuing to buy into for a long-term hold. Next up, we'll be looking at Google, or Alphabet really, which is a company that we looked at previously when they had just released their Q3 earnings for last year. Now, since then, the stock's been relatively flat following the rest of the tech market as a whole. Now, Google's another digital advertising behemoth right up there with Facebook. In fact, they even have a larger portion of the entire digital advertising market share. And this is a company that continues to expand at an incredible pace, also venturing on into cloud computing as well as other diversified business verticals. The stock itself, though, hasn't been destroyed like Lightspeed and Facebook, but rather it's down around 15% from its all-time highs and has also since bounced back a bit, now sitting around 8% below all-time highs. And also, now that the company's announced a 20-to-1 stock split, this has a lot of investors wondering whether or not right now is a good time to buy. Oh, and by the way, if you're not familiar with what a stock split is, in this case, a 20-to-1 stock split, Google's shares currently trade for around $27.50 per share, which is a lot. And a 20-to-1 stock split essentially means that every single share is going to be divided up into 20. So one share right now, $27.50. After the stock split, it would be around $140 per share. And everyone who were to hold one share of Google before the split would then end up with 20 shares, but at the exact same market value. So naturally, the stock did rally upon this news of the 20-to-1 stock split, though, as they usually do. And typically this does have a positive impact on longer term growth anyways, just based on investor psychology and based on the fact that it's somewhat easier to access purchasing shares of said company. In fact, we've seen this time and time again with other tech stocks over the past couple of years, like Amazon, Nvidia, as well as Tesla. Even though from a material underlying standpoint, this doesn't have any difference whatsoever on the company's value as well as their market cap. Usually when we see a stock split of a really expensive company, or a stock I should say that's really expensive from a nominal value, this has a perceived psychological impact of positive movements over at least a shorter period of time. So Google's stock split is expected for July 15th, and let's now speak about their most recently reported financials, because once again, absolutely fantastic quarter for this company. First off, Alphabet reported revenue growth of 32% year over year, proving once again that it was able to withstand the pressures from the pandemic, and Google's advertising revenue came in at $61.24 billion for the quarter, up 33% from $46.2 billion in the same period a year earlier. Now, in regards to Google's cloud business, they also reported revenues up 45% to $5.54 billion, and the operating loss in the cloud segment came in at $890 million during the quarter, which narrowed from the $1.14 billion loss a year prior. And then finally, in Google's other revenue segment, which included hardware, their Play Store, and non-advertising YouTube revenue, they managed to rake in $8.16 billion in sales, which is up from $6.6 billion the year prior. Finally, what about Google's price to earnings ratio, right? So taking a look at this chart right here, we can see that it is still really low for their own company, in the 24 range, which it rarely reaches and usually trades at above a price to earnings ratio of 30. So yeah, all this to say that Google's continuing to show tremendous levels of growth even at this large of a scale, and this is combined with outstanding levels of profitability. All right, so we took a look at 4 different tech stocks in today's video, each trending differently in the current market environment. Make sure to comment down below what you think about each one of these stocks, whether or not you think either of these are buys, holds, or sells currently in the market. Now, I'd also encourage you to check out the top link in the description to get up to 5 free stocks, each valued up to $3,500 a piece when you open up and fund an account with Moomoo. So with that said, thanks a lot for watching, and I will see you in the next one.